The next major crash is already building. It is not an event on a calendar. It is a systemic process that began years ago. The massive accumulation of debt, speculative bubbles in asset prices, and reliance on continuous monetary stimulus have set the stage. What you are seeing now is the build-up phase. History shows the pattern. Cycles like 1929, 2000, and 2008 followed the same arc of easy credit, excess, and reversal. This documentary will walk you through the mechanics of this hidden cycle, from initial credit expansion to contraction. The warning signs suggest we are approaching a critical juncture. The question is how this rebalancing unfolds. Which brings us to the core mechanism behind what is unfolding. The architecture of collapse, the hidden cycle in motion. We often assume market crashes are sudden, unpredictable events. But the reality is they follow a predictable, mechanical pattern driven by credit expansion and contraction. This cycle operates with the logic of a physical law, not the randomness of chance. The process begins with a period of easy money. Central banks lower interest rates and increase the supply of credit. This makes borrowing cheap and encourages both consumers and corporations to take on debt. The goal is to stimulate growth, but it has an unintended consequence. This cheap credit flows into speculative investments. It inflates asset prices, from real estate to stocks, far beyond their underlying economic value. The tension builds invisibly as prices detach from fundamentals. The system looks healthy on the surface, but it develops a deep structural fragility. Think of it like a pressure cooker. The heat of easy credit builds pressure inside the financial system. Now let us look at the historical precedent. Roughly every 18 to 20 years, the valve turns. 1929, the stagflation of the 1970s, the dot-com peak in 2000, and 2008. The relief valve is higher interest rates, which central banks must eventually use to combat the inflation that the credit boom itself creates. Turning that valve is the trigger for the release. Historical precedents show this cycle repeating with remarkable consistency. Major economic dislocations are not random accidents. They are the logical conclusion to a period of excessive credit expansion. The system reaches a point where the debt burden cannot be serviced without even more credit, creating a dependency. The current environment exhibits all the classic hallmarks. Corporate debt has swelled to levels that make 2008 look conservative. Stock market valuations, by measures like the Shiller P/E ratio, have pressed into territory only exceeded before the dot-com crash. The Federal Reserve's balance sheet expanded from under $1 trillion before 2008 to well over $8 trillion, illustrating how much artificial support has been required and why there are limits. Dependency. It comes down to this. The crash is not a date, but a condition created by leverage, inflated valuations, and policy dependence. When debt grows faster than the capacity to service it, the adjustment happens through inflation or default. Either path transfers wealth from the overextended to those positioned with resilience. What this means for you is simple. Once this cycle releases, the market won't distinguish between weak and strong at first. Your edge comes from knowing which assets can withstand the pressure when everything is sold at once, which is why the next move is practical. Triage for your portfolio, identifying assets that can hold up under stress. When the systemic pressure releases, markets often enter a phase of indiscriminate selling. Fear dominates. Strategic selection becomes paramount because not all assets are created equal. The difference between survival and failure comes down to a few critical characteristics that determine durability. A common mistake is fleeing entirely to cash. While cash provides immediate liquidity, it carries a hidden risk: erosion by inflation. In a crisis, Central banks often respond with monetary stimulus that can devalue currency over time. The other mistake is holding purely speculative assets that may not recover. Their value rests on narrative, not fundamental utility. The triage process requires looking past sentiment to the underlying resilience of the asset. Quality is concrete: strong balance sheets, low leverage, and consistent earnings from essential goods or services. Look for companies with high interest coverage, ample free cash flow, and conservative debt ratios. They sell what society must buy in any environment: utilities, core consumer staples, basic healthcare. Demand is relatively inelastic. Companies with reliable cash generation possess a critical advantage. They can maintain operations, service obligations, and keep investing when credit tightens. This stability allows them to do more than survive. They can acquire weaker competitors at discounted prices and expand market share into the recovery. Real estate makes the distinction clear. Prime locations with intrinsic utility and scarcity value, well-located apartments, logistics hubs, essential commercial space, tend to retain value because they provide necessary functions. In contrast, speculative developments in marginal areas, financed by cheap credit and optimism, can become effectively worthless. What endures is not the structure, but the usefulness of the land and the location. Precious metals like gold serve a different role. They are a store of value and a hedge against currency debasement. Their function is not rapid growth, but the preservation of purchasing power when currencies lose credibility and financial systems strain. Think of them as insurance, not a performance engine. The strategic goal is not only to preserve capital, but to be positioned for recovery. The key differentiators are clear: strong cash flow, low leverage, and essential utility. That margin of safety is what endures, and in a downturn, it also creates opportunity, because those with resilient assets and liquidity can buy quality at a discount. From here, the question shifts from what to own to how to act. When the screens are red and headlines amplify the fear. Which brings us to how you execute under stress. The psychology of acquisition. Buying when others are panicking. The greatest barrier to profiting from a crash is not financial, but psychological. It requires acting against every natural instinct for self-preservation. When fear dominates the market, the impulse to sell and seek safety is powerful. Overcoming this impulse is the fundamental challenge. At the peak of crisis, coverage intensifies, and narratives of systemic failure multiply. Widespread fear creates strong social pressure to conform, to sell alongside everyone else. This environment generates cognitive dissonance. Your analysis may indicate opportunity, but the prevailing story warns of immediate danger and deeper losses. A core driver. Extrapolation bias is the belief that what is happening now will keep happening. In past crashes, quality businesses traded at prices that looked impossible. World-class franchises were marked down to single digits. Investors assumed the decline would never end. As selling feeds on itself, the mind struggles to conceive of a reversal, and undervaluation looks like risk rather than opportunity. Successful investors counter this with disciplined contrarianism. They adhere to a predefined plan rather than emotion. The strategy is built in calm periods, specific actions for specific conditions, removing the need for improvisation when volatility spikes. They understand a critical distinction. Panics are temporary, but the assets acquired at those prices can compound for decades. This discipline has a structure. It starts before the downturn by raising liquidity during optimism and high valuations. That often means selling into strength while others celebrate. Then, when fear is pervasive, cash is deployed systematically according to preset triggers. The mindset shift is simple, but not easy. Treat falling prices as a discount on long-term value, not a verdict on permanence. History validates this approach. In 2008 to 2009, those who bought high-quality assets at distressed prices were not lucky. They were prepared to act when action felt most dangerous. Even the largest pools of capital show this posture. Berkshire Hathaway has sat on a massive cash reserve, signaling that smart money builds optionality first, then moves when price dislocations appear. The reality is that crashes reprice ownership from the emotional to the disciplined. It comes down to this: wealth transfers to those who can keep a plan when others abandon one. What this means for you is straightforward. Structure your rules now, build liquidity, and train your response so you can execute when it feels hardest. From here, we step back to the broader frame, what this reset really does, and how to position so preparation, not prediction, determines your outcome. Here is the conclusion. The reset is not an endpoint, but a transfer mechanism. It reassigns wealth based on preparation, discipline, and a clear understanding of the system's architecture. Crashes do not eliminate wealth. They redistribute it from the unprepared to the informed. History repeats this pattern because cycles and human behavior repeat. Your action plan is specific. Build cash reserves during